So here we are, we're looking at some promising returns on the African continent, various countries returning some double-digit numbers as well. And then in the midst of all of this, we're worried about what's happening in the Eurozone. We're concerned about a possible hard landing in China. And Africa is delivering on some of those promises being made. So overall, we're painting a very positive picture for Africa.
Absolutely. We still remain very constructive on a number of countries in Africa, not least because we feel that they are relatively protected from what's going on in the rest of the world, but also because endogenous cycles that have been embarked on when we ran into the crisis and these countries adopted overly expansive fiscal and monetary policies are now yielding positive returns as these cycles adjust to a more tighter and subsequently more loose monetary and fiscal stance. So we feel that these countries, including Egypt, including Angola, Nigeria, as well as Kenya, are offering interesting opportunities for investors to continue to receive uncorrelated returns that will be shielded from what's happening in Europe as well as in China and potentially even the United States.
Okay, so Yvette, are we actually looking
that the African continent will continue to grow?
Yeah. So Yvette, are we looking at, when we say returns, are we looking at returns on the equity front? Are we looking at the bond market? What kind of asset classes are you looking at within these areas that we speak of?
So what we spoke about earlier is with regards to the endogenous cycles that followed from an overly expansive monetary policy. So in East African economies such as Uganda and Kenya, and to some extent also in Nigeria, we had very attractive carry trades that followed from the significant tightening in monetary policy. So we had those obviously policies adjusting to the inflation and depreciation cycles that emerged from the overexpansion of their economies, and these significantly higher interest rates have offered very attractive carry trades in these three economies. We still remain constructive that Uganda and Nigeria for the time being will continue to offer these very attractive carry trades and potentially starting to look more attractive from the duration perspective. We feel the duration perspective and investing in longer tenor bonds has actually run its course already in Kenya as the yield compression has already emerged there, but we feel that there's likely to follow significant yield compression in Uganda and in a more longer term in Nigeria by the end of this year. So we're increasingly looking into the longer tenor bonds to gain exposure to these markets and benefit from, as we mentioned, the adjusting monetary policy as well as yield compression that will follow from the disinflationary cycle. Okay,
so we've also seen a few Eurobonds coming online from various African countries. Do you think that this is one way that investors are also going to look at, getting themselves exposure to African economies, but through a Eurobond?
Absolutely. I mean, we've continued to be very positive on, for example, Cote d'Ivoire's Eurobond. This has offered considerable return, and once they get up to date on their payments from June 2012 onwards, we do believe that there's further upside to the price of their Eurobond. So we are a strong advocate of the Cote d'Ivoire Eurobond. And obviously there will be a number of countries that are looking to enter the Eurobond space, which could offer interesting opportunities at their primary issuance. And this includes not least Zambia, who's likely to come to market within a number of months.
You were talking about compression of yields over in Kenya, and if we see the interest rate cycle right now, we've got very high interest rates sitting at 18%. We've got a slightly sticky inflation rate, but still starting to show that it is moving lower. When you see the economic environment in some of these regions that we are alluding to on the African continent, we're seeing high inflation, we're seeing decent growth rates, we're seeing very high interest rates as well. So this could actually start shifting if we do see some kind of shift occurring as well on the global growth fronts and global economic structural fronts as well. Yvette, is that the right assumption to make?
So what we're seeing is that there's obviously a shift from a tight monetary policy stance, and you referred to Kenya specifically, that they actually haven't embarked formally on a easing cycle when it comes to the monetary policy rate. We have actually already seen that the T-bill rates have come off quite considerably. So there has been already an adjustment in interest rates to the expected disinflation and an easing in liquidity conditions. So this shift in interest rates and moving downwards from a fixed income perspective is likely to see a shift into the equity markets from the fixed income space, and we're likely to see those interest rates become more supportive of growth. So that growth is likely to pick up in these markets, and we're likely to see a very strong rebound in these economies. And this will offer opportunity regardless of what might be a spike in global risk aversion. Obviously, the overall investable pool of assets from a global perspective will be affected by events on a global scale. But what we're seeing is that we expect net investment flows to Africa to pick up regardless of the global environment. And we're seeing that these trades are less affected by the high beta global growth related trades and therefore less rapid reversal of these trades when we have a spike in risk aversion.
I mean, Yvette, you were talking about the carry trade as well, and looking at economies such as Nigeria. We know a lot of these African countries intervene in their currency to ensure that it remains relatively stable against the US dollar. And when I see what the dollar has been doing and strengthening dramatically against most emerging market currencies, one would wonder how much intervention we'd have to see by the central banks in Africa to ensure that these currencies remain relatively stable. How much of a risk is this down the line? I mean, again, it really all depends on the firepower of the central banks to be able to contain, a blowout in their local currencies.
Right. What we are seeing is that a number of economies have been affected by the most recent spike in global risk aversion. So we have, for example, seen some flows flowing out of the Nigerian fixed income market. And this has to some extent added to upward pressure on the currency, which has forced the CBN to respond. But we also saw that the CBN maintained its interest rates flat at the monetary policy meeting over the past week. And this is obviously to ensure that real rates do offer some protection to the currency. And that's likely to remain the case until we feel that the economies are picking up significantly and they feel comfortable that they can switch to a more easing cycle.
Okay, so Yvette, point of the story here is that if you're not invested in Africa, you could lose out on double-digit growth for 2012, right?
Absolutely. Double-digit returns are obviously available in some of the fixed income markets at present, and we do believe that the equity markets in Kenya and over the longer term, towards the end of this year in Nigeria, those markets have already been performing well, as well as with Egypt. So together with the carry trades that we've mentioned, as well as some of the duration trades that are available, equity markets are likely to look increasingly attractive.
Fantastic. Thank you so very much, Yvette. Great to have you on the program. That was Yvette Babb, Africa Research at Standard Bank.